Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. We've got equity markets, and all markets actually, pretty much red across the boards right now. The market narrative has certainly shifted sharply in recent weeks, with AI enthusiasm giving way to skepticism, certainly some skepticism. Adding to the uncertainty is some concern that the Federal Reserve may hold off on a third rate cut next month. So what does this changing backdrop mean for the evolution of defensive stocks? Are they still playing the exact same role in portfolios, for instance? And how does the quality bias fit into this environment at this point? Especially as global markets take on a bit of a barbell structure, you could argue. We'll talk about that with our next guest joining us here today to explore some of these themes and discuss why the case for dividends may be stronger than before is Portfolio Manager Ramona Persaud. Now, Ramona manages several Fidelity funds, including Fidelity U.S. Dividend Fund and Fidelity Global Dividend Fund. Warm welcome to you, Ramona. Great to see you. How are you?
I'm all right. Nice to see you too, Pamela.
Great to have you join us here today. I'll just remind everyone joining us here today that this webcast features live French interpretation, so do join us in either official language and send questions in for Ramona over the next little bit. Ramona, let's begin with the market story. It's a time of concern, and for all of the reasons that we just pointed out there. Do you pay a lot of attention to this? What are you paying a lot of attention to right now? Your style is not really an AI type of setup. Tell us what you're paying attention to and always do pay attention to.
Yeah, thank you, Pamela. The core of my investment process is around the ways in which valuation and quality combine. So I am trying to get the best quality business I can get for as reasonable a price as I can, and typically as low a price as I can. But if you get quality for a very, very low price, there's usually a lot of controversy or apathy in that. So I'm always paying attention to that combination, including today. And to expand on how you opened, I've thought of the market since mid last year actually as kind of an accordion, where the market essentially expands and contracts around this element of glamour. And glamour is the really fast-growing parts of the economy that are relatively unfazed by the macro. And I mean relatively, so not absolutely unfazed, but relative to the rest of the economy, less subject to macro fluctuations. And so AI, and for some time, GLP-1 analogs have been considered sectors like that. So the market at times will concentrate into that sort of glamour hypergrowth stuff, but then when it gets really expensive, typically, the market will then often have a moment like we're in today, where it pauses, digests, and then the accordion kind of opens up again, and the market broadens out. And depending on what data points come our way, the accordion has sort of had a kind of movement to it. So it's felt that way for the last 18 months. So what we're seeing today.
So 18 months. Okay, so that's taking us back. We're going back to sort of summer of 2024. This is, it seems like a long time ago, doesn't it? Because this year has felt rather long. But that was sort of in the beginnings of the rate cutting cycle for the Fed.
Mm-hmm. That's exactly right. So last year, first half, and I only take us back so that we can really contextualize today, was very, very strongly glamour oriented. And that's because we had come off of a long period of tech in the era of rising interest rates, and certainly glamour tech having a massive indigestion period. And so the market sort of got to a digestion point, if you will, where it could embrace glamour again. And that worked spectacularly well in the first half. Then we got to a point where inflation essentially subsided, and the market started to really want monetary easing or anticipate monetary easing, which in the presence of tech and glamour tech being more richly valued, so that was a powerful combination of monetary expectations changing and expensive glamour, the market just, sort of hit glamour really hard and expanded back out into more economically sensitive areas. So that was when that accordion idea really took hold in my mind. Like, okay, we're gonna move between these two states or these two orientations. Then early this year, we saw DeepSeek, January 27th, which again, like massive indigestion in glamour tech. Um, the market started to try to find other areas to go. And then we got like the shock and awe of tariffs and other sort of new administrative policies, which got the market to like refocus again on glamour because it was a place to hide. So again, this like, accordion feature, it's almost like the market's making some kind of music, if you will. So what I've done with all of that is just constantly think about valuation, go right back to my process, which is where is valuation getting more extended and where are there some opportunities. So today, and this has been the case since late last year, for instance, there's still some opportunity in US versus developed non-US markets. So there's still pretty good valuation spread between US and other developed countries like the UK, continental Europe, Canada, if you will. So I've been searching in those areas for incremental stock ideas.
I mean, and one of the other features of this year, which you've been doing for years, and living, you're an international person, you've lived in lots of different places around the world, you've been living the international opportunities of equity investing for much of your life. The rest of the world, it seems in North America anyway, has not. They've been invested in the US for the last decade and plus. But this was a year of diversifying, and rightly. But this suddenly was the diversification into international. So I'm sure you were there waiting with open arms, or at least you have a comment on that.
Yeah, what's been hard in international only makes sense if you're sitting in the U.S. International means non-U.S. I'm going to say U.S. versus non-U.S. is that valuation difference between US versus non-US, like just kept opening and opening and opening over the last, basically coming out of global financial crisis. And you have to kind of like contextualize it against interest rates. So coming out of global financial crisis, the response, the solve, if you will, to global financial crisis was massive, unprecedented monetary easing, which was done exceptionally at an exceptional level in the US. So there was a little bit more discipline, it could be argued, in other parts of the world. So at the margin, the money was freer, perhaps, in the US. And so it just lit a fuse under long duration cash flows. So cash flows way out into the future, which is another way of saying glamour. So in that context, that stuff took off in the US and it made the US market just take up. So the valuation spread between US and non-US, and certainly US and Europe felt very stagnated because they came down like super hard on their banks relative to the US, which showed up in monetary policy to some extent. The valuation spread just kept expanding and expanding and expanding. So the problem was not knowing when the turning point would be, if there would be a turning point. And the way that I measure it is in terms of standard deviation. So at the end of last year, we got to like 2.5 standard deviations, US versus EFA, relative valuation spread, which was pretty meaningful. It's still around 2 today. And that's the only place in the market where I can get valuation spread, which is a measure of like relative controversy or relative apathy or fear. So there's still some decent opportunities ex-US. Now, in my US strategies, there's only so much I can do with that. I don't want to go too far outside the US, but I might end up in more multinational businesses, more global businesses. I might, if two companies are both global multinationals, I might choose the European listed one versus the US listed one because there's often a valuation discount that doesn't make sense. And certainly in my global strategies where I can be all over the world, that was definitely a signal to, and I was already there, frankly, to be much less US ex-US.
Okay, it's fascinating. I mean, there was some comments, I don't know, this is going back a few months, but if there was a barbell, it was this idea that you can't ignore sort of US tech AI, but if you need to have in your portfolio, for instance, a grocery store, it's a lot cheaper to have a European grocery store than it is to pay the valuations for the U.S. Equivalent, because there was a lifting of all boats across U.S.
Yeah,
markets.
it can be. The typical example was less staples. I mean, there were some examples in staples. So like Unilever versus P&G was
Okay.
one example, or not necessarily Nestle versus P&G. So that was interesting. The examples showed up a lot more in industrials. So like a Siemens versus GE.
Right. Okay.
For the longest while, you could buy Siemens a whole lot cheaper than its US equivalent. So in industrials, I found a lot of examples like that, or even in tech, definitely in tech, where US tech had this, very brilliant, shiny glamour umbrella that boosted valuations. Some of it justified, some of it maybe not, versus there's just not a lot of European glamour tech. So yes, you could. A lot of that just contribute at the stock by stock level. That is what contributed to like an aggregated 2.5 standard deviations coming into this year. That still is around 2 standard deviations. So that is a way that as a global investor, you can just really parse apart the global market to figure out where the opportunity is, where the arbitrage is, essentially.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
That's completely fascinating. When you take a look at what investors want right now, because you'll see some who have decided it's the time to take gains. Again, these are headlines which you don't follow, but there's this thought that glamour stocks, as you call them, have gone too far, time to take gains. That said, if you have a more total return dividend strategy, I mean, you're still getting paid. You perhaps don't have to go and cash in chips in the same way. I wonder what your strategy means for a lot of investors right now who maybe have made gains elsewhere and are interested in a little more safety.
Yeah, I just at a very fundamental level, the way that I approach investing is both to find excess return, which is what everyone wants, but also to do it in a way that is very sensitive to the risk embedded in those returns, which typically is proxied by volatility. So volatility in the returns, and that matters a lot in moments like recently where you've had drawdowns, because in drawdowns, when volatility is potentially higher, often higher, investor confidence is shaken, and that almost always comes with churn that's not productive. So essentially selling at the wrong time and often buying at the wrong time. So if you dampen volatility in the return profile, dampen churn, you increase investor trust, investor stickiness, which means that investors have a much higher chance of capturing the total ultimate return of the underlying fund in which they're invested. And so that's a big part of my core belief system, is to really try to take care of the volatility profile and the returns as much as I can to increase investor trust, to reduce churn so that I can get them as close to the underlying fund's total return. And so in moments like this, where there's fear or there's like a transition or just the markets opening out, however you want to characterize it, where the market feels like it has this shift from one thing to something else and investors get really scared, it can be really helpful to have some allocation, some proportion of your strategy in instruments or funds that are really volatility sensitive.
Mm-hmm. And what is, I mean, we speak a lot about correlations because, again, this is that moment where you don't sort of want to see lots of things go down at the same time. And so how do you maneuver through that? How do you make sure that you find enough places where you're investing, it's not correlated too badly to all the glamour stocks we're talking to? It seems like everything is AI right now in terms of a play.
what's always been internalized in me that I now have like external language for is what I call anti-correlation. And I think it just comes out naturally of a process like this. It's just I'm now like putting a label on it, which is it comes out of being valuation sensitive. And so that doesn't mean buying cheap for cheap's sake. Remember that I started out saying I'm trying to get the best business I can for a really good price. So that drives a certain kind of quality and valuation sensitivity. When there's a valuation sensitivity, and especially if you're in a market that has this like momentum quality to it, there's a way that you end up in lower momentum names or literally anti-correlated to the strong momentum that's driving the market. So especially when the momentum factor, if you will, is just getting reinforced and reinforced and reinforced in greater and greater sort of performance. And if you like kind of measure the valuation of momentum, which is a really interesting like factor on factor thing to do, and that gets out of bounds, certainly from a statistical perspective. So if you like sort of standard deviation, the valuation of momentum, there's signals like this that if you're valuation sensitive will push you into anti-correlation. So to make that more concrete,
That's interesting.
stuff cheap. So like packaged food and spirits have gotten really cheap because people taking GLP-1 analogs no longer want to, impulse drink and impulse eat bad stuff. Pharma has gotten really cheap because of administrative policy. Often the legacy, low growth or X growth parts of tech can be cheap relative to the glamour stuff. So naturally, a valuation sensitive process gets pushed into anti-correlation. And on top of that, I've tried to be very intentional to be anti-correlated, knowing that there's a ton of unintentional AI in most people's portfolios. You would have to be incredibly intentional to get the AI out of your portfolio. So knowing that there's probably more in mine than I'm intending, I've been trying to find either AI laggards or stuff that's quote unquote anti-correlated, like packaged food, or like something like a tech company in Asia that didn't get the AI chips quite right and got down to less than 1 times book. And the sort of alpha odds go up a ton when you go below 1 times book, which is what I learned looking at this company 15 years ago for the last 15, 20 years. So things like that really help to protect the portfolio in moments when glamour gets just overextended. Other things called undisturbed by glamour.
Undisturbed.
So there's anti-correlated and then there's maybe undisturbed, which are slightly different things. So if AI and GLP-1s have been the areas of glamour for the last several years, what are the parts of the market that no one's interested in or that have more controversy in them? So the sort of low beta part of financials, or there've been some like mid-cap European healthcare names that no one really knows about, or certainly U.S. pharma. What are some parts of the market that people just don't care about and don't want to touch? That can tend to be protective against the unintended stuff in your portfolio that gets caught up in the
and ultimately can propel it to go higher when people are trying to shift out of what they're trying to shift into and shift into something else, essentially. I mean, does that, you're already there in a lot of those cases.
It just it's a way to intentionally get some diversification, especially with my thesis, if you will, having been since last year, this like accordion feature to the market where it's essentially sort of cycling in and cycling out of glamour. And the turning point is when you get like often the valuation of momentum just getting overextended.
Okay.
So then the market will shift, often will just shift into something else. And to me, diversification has helped a lot to keep the violence in my portfolios minimal.
So GLP-1s, to an extent, I mean, as we understand it, got a bit thrown out with the bathwater because there was just, tell us about the policy side of it, and then also perhaps just being too overextended and glamorous for a period of time. Where are they now?
It had, I think there's less momentum in that than there has been in AI. It definitely had a strong momentum element to it a few years ago, and it's, there are different versions of these GLP-1 analogs. There's more controversy in that space than there was several years ago. So there's some decent valuations there now. Eli Lilly has been the poster child glamour stock, but there have been some other stocks that have really struggled despite having similar drugs. So there's more controversy now that makes it a more interesting place to invest. It hasn't kept up with the glamour of AI. The controversy is around pricing and around addressable market, whether the addressable market is quite as large as we think it is. And there's lots of different views. So when you've got dispersion in views, you can get some dispersion in valuation. What I've liked is less those companies, because it's to me it's hard to really call. The range of outcomes seems wide. I don't tend to be an early adopter to stuff. My kids give me a really hard time about the fact that my iPhone is, I don't know, 4 generations ago or something. And I like it that way. So when there is new, super new cutting edge technology, such as, say, that drug or AI, that's not my sweet spot. My sweet spot is the stuff that's left behind, stuff that so much fear gets introduced to it because of the leading edge stuff, which people like Mark Schmel are exceptional at. I like the stuff that's left for dead. So packaged food, pharma, tech company in Asia that didn't get AI right and got left behind, laggards. Because often there's a pocket of valuation that just gives you a lot of alpha odds in those moments.
So dividends are sort of, I think, also the antithesis of the accordion analogy that goes maybe with glamour stocks. I mean, they tend to be pretty steady. It's a bit shocking when a dividend's cut. Sometimes they are, but it's a big deal.
Yeah. I guess you could argue, though, that your typical dividend stock, like call it telcos, regulated utilities, maybe healthcare, pharma, those are wrapped up in the accordion because they are anti-glamour.
Okay.
So those are great sources of typically of anti-correlation. So I have, to the extent you can get the valuations for those, I have leaned into them to try to just get me some diversification. So large cap pharma is a really good example where I can get decent alpha odds from low valuation. I can get great portfolio construction from low free cash flow, high free cash flow production, and low variability. So just those are measures of quality. So I get low valuation, high quality, low beta. So from a portfolio construction perspective, if you can stock pick well, that is an awesome place to be relative to the other low beta, high dividend yield parts of the market. So like regulated utilities are very sensitive to interest rates in a way that large cap pharma is not quite as much. Staples have been really difficult. So that's just gotten like very, very dislocated from a structural fundamentals perspective. So I've sort of hidden out in large pharma. It's not totally safe because the administration has come after it, but if you're going to be in cheap, you have to take some kind of fear risk. So I've decided to do that.
In pharma, okay, fascinating. And would you say the policy risk is settling down a little bit? There's a bit more clarity there?
I think the word is still shock and awe. I think it's like whack-a-mole, right? Whack-a-mole, which is like, what target are we going to, socialize next? Socialize is the wrong word, especially when talking about this topic. I don't mean socialize like shared costs. I mean, what target are we going to advertise next? What target are we going to like put the focus on next? And for a time, it was healthcare and drug pricing, and it may be again, but it keeps moving around. And in so doing, you get a ton of volatility, you get some valuation opportunities, and frankly, the market is a very sophisticated, complex, highly intelligent system. So the market gets inured pretty quickly. So what I wait for is you get that initial few shocks of volatility. The companies keep adapting to the challenges, and then eventually the impact of the shock is lessened because the market's more inured, and that's when your like 8 times earnings gets really rewarded.
Your strategy is something that you've honed and crafted and talked about where it's come from and your approach. Sometimes that works well, with some of your colleagues who have a slightly different approach. Tell us about that, because it is, again, an interesting moment where there are those who say we don't want to catch a falling knife, we want to, get out or get in, but you don't want to miss some of the gains, I guess, for some people that are going on in some of these glamour stocks. How do you work with other portfolio managers to learn from them, but also potentially to kind of pair up different styles together?
So I'll step way back and say I think one of our most maybe nuanced or least tangible strengths, the way that we approach, people and talent, is autonomy. So we have this way at Fidelity of just giving people incredible levels, like scary levels of responsibility almost. And it comes with, therefore, so much trust. So there's this incredibly high trust that's conveyed when you're given an assignment. And you hire bright, really motivated, hungry people, and you put that together with trust, it tends to work in your favor. So what that means is I feel a deep sense of trust in being able to pursue my goals, my investment mandate in a way that's authentic to who I am as an investor. So the way I approach dividend investing is not only am I looking for dividends, I'm looking for really good valuations and great companies. And if I can get some good dividends out of that, that's a really beautiful trifecta. Other people, according to who they are, might approach dividend investing where they really focus on the dividends and not any other factor. I love about Fidelity is we are put in a position of pursuing the mandate according to our intrinsic strengths. And in so doing, with the right management, if you will, and the right guardrails, we're able to build this diverse ecosystem of investment styles and outcomes that I believe, works really well for the end investor. So that's kind of like an overview question. How I work with the other portfolio managers is the three people in the offices that way. They all have dividend mandates. We all do them extremely differently. There's one person who is not nearly as valuation sensitive as I am. He is all about excess return. So he will just have a very different style from me and have very successful outcomes. The person in the office next to me is much more valuation sensitive. So he will go for extremely low valuations and also be successful. I tend to like complexity. So I'll take a bunch of essentially factors and combine them. And essentially I'm constantly trying to optimize factors. So my optimization is around quality, value, and dividends at a first level. And then at a second level, it's around the volatility embedded in that return stream, downside protection, up and down capture. I just love taking tons of variables and putting them together and seeing what I do. We all do it differently, and we all end up having really successful outcomes because the guardrails are very well protected. So I love being able to learn from them because I think we help to inform each other's styles and processes.
And what would you say if people are joining you here today to sort of look out to, what is your horizon? I know it's a bit of a broad question, but for those that might want to look a little past, say, the next month or two, what would you say your horizon is?
So concretely, it is probably 3 to 5 years, and my turnover would show that. The turnover in my funds is fairly low. I like to think of companies through a market cycle, and I like to think of the returns in my funds through a market cycle. The alpha that I produce in my strategies is not linear. It has a lumpy quality to it because the style of my funds are fairly, they're not linear, they're fairly specific. My funds are conservative, alpha driven, and also downside protection driven, which means that later in an economic cycle, there's plenty of alpha in a strategy like this. And through a recession, lots and lots of alpha. Early cycle can be harder, then mid to late, stock picking really shines. So I can pick up a lot of alpha during mid to late, and then into late and recession again. So over the course of a market cycle, I should be able to produce, this is the way that I think of what's possible, an alpha profile that is, again, not linear, has a certain shape to it, but is beneficial to the end investor, especially on a risk-adjusted basis. So when I think about time horizon, I'm really looking market cycle to market cycle, which can be 3, 5, but in my mind too, I want really strong 10-year returns, 10 plus year returns for my own investors.
Ramona Persaud, it's such a pleasure to speak with you and to hear your calm voice and deep thinking in these markets right now, because it's easy to kind of flit around, and you're a real anchor there. Thank you for joining us.
My pleasure. Thanks, Pamela.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.